Now let's practice our project appraisal skills. And we start with the understanding of relevant cash benefits and relevant costs. So, relevant means those that change because of the decision has been taken. We have a bookstore that occupies 100 square meters and brings about 10,000 of weekly contribution. You want to open a coffee stand that would occupy 2 square meters. To do that, you would have to hire a barista at $500 a week. Mhm. So, hiring a barista is this extra cost. So, that is something that is experienced because of the decision to open a coffee stand. So, baristas pay would be a relevant cost. The overall rent paid is $400 weekly. When we are talking about performance evaluation and evaluating the divisions, evaluating products, projects, then obviously we would take this 400 and we would split that. We would add 2 shares to the coffee stand and 98 of those to the bookstore because they occupy this square meters in this proportion. But when we're talking about relevant costs, we do not take into account that because rent is going to be paid no matter what. Each cup of coffee costs $2 to make and would be sold at $5. So contribution that is paid per cup is $3. And we need to take this $3 and multiply by the quantity. And we know that it will be 1,000 cups of coffee. So that would be 3,000 of contribution. And coffee customers will increase sales volume of books by 10%. Well, the sales, that would contribution with a plus sign, then books extra sales would be, well, actually, we are taking not sales, but contribution. So we need to take sales and we need to take this variable cost. But in this case, when we're told that it brings us 10,000 weekly of contribution, we just take 10,000 and multiply it by 10%. So it's 1,000 more. And this means the relevant benefit of this decision would be 4,000 minus 500. So that is 3,500 weekly. Now, let's talk about ratios that we can calculate in respect of any decisions that we make. We need to calculate return on capital employed. It can be called return on capital employed. It can be called accounting rate of return. Now, we have a company that has profit before interest and taxation, profit before taxation, profit after tax, and we know equity and non-current liabilities. When we are talking about return on capital employed, we are talking about all capital employed, so not only equity, but also long-term debt. So this means that we're going to divide by the sum of equity and non-current liabilities. When we are talking about the return that we need to divide, that would be a return that is going to be split between equity holders and debt holders. So this has to be profit before interest. So it would be 4,500 profit before interest and tax. If, however, we were supposed to calculate return on equity, then we would divide only by equity, so only by 15,000, and we would divide something that is distributed to equity holders. It's not profit before interest and tax. It's not profit before tax. That would be profit after tax. That is because only profit after tax is going to get distributed. Only that is used to pay out dividends. So profit after tax is 2,800. Now let's calculate the values of that. So return on capital employed, we would have 4,500 divided by 20,000. It would be 22.5%. return on equity would be, we would take 2,800 divided by 15,000, that is 18.7%. Now, in this case, we have return on equity that is lower than return on capital employed. It is not always like that, actually. It would depend on how much liabilities you have, what is the level of taxation, what is the level of interest. So sometimes return on equity can be higher, sometimes return on equity can be lower, like in this case. And let's have another practice. In this practice, we will need to calculate lots of ratios: return on capital employed, payback period, NPV, and internal rate of return. So we have a company that has invested 50,000 to buy a machinery that has a useful life of 10 years. The machinery will be used for project beta for 4 years, and then it will be sold at zero profit. The fact that it will be sold at zero profit means that we will need to calculate the carrying amount by that time. So what will be the carrying amount, which equals to sales proceeds, sales from this machinery proceeds? That would be 50,000 minus 50,000 divided by 10 years and multiplied by 4. So this means that we're going to take 50,000 and subtract 20, and it leaves us with 30,000. That would be whatever is received in the end. Project Beta will be sold at a markup of 25%. Paying attention to whether it is a markup or whether it is our margin, because it would depend, that impacts the way that we calculate profit or revenue and so on. Okay, so that is it. And let's read further ahead. It will earn annual revenue of 30,000, and we will have 4 years of that. Selling costs, so fixed costs, are 4,000 annually. Now, let's calculate payback period first. Payback period is calculated from the perspective of cash. So cash flows only. We have today, so today is T0, and today we need to make an investment of 50,000. In year 1, we are going to get the annual revenue of 30,000, but we do not care about revenue. We care about whatever is left. So what is the net cash of that? We know that the markup is 25%. Markup is given on cost. So this means that 30,000 is some cost plus 25% of this cost. So this means that the profit that we're going to get is 30,000 multiplied by 25% divided by 125. That is going to be the this contribution profit without the accounting for any fixed cost. And then we also have this fixed cost. We have expected selling cost, and this selling cost are going to be 4,000. Now, what will we have? We have 30,000 multiplied by 25% divided by 125 minus 4. So we are going to have, okay, that looks a little bit too little. I think that was something was supposed to be bigger. How about we just change that, and I will change that in the scenario that we have. So let it be 80,000 and probably, and not 30, so that we would have higher returns. Okay, so what does it mean? It means that we will have 12,000 of net cash inflows for year 1. And the same will be for year 2. And the same will be for year 3. And by the end of year 3, we haven't paid back our initial investment because we have earned 36,000 of inflows. However, our original outflow was 50, so that is a lot. So in year T4, we would have this 12,000 of return, which would not still be enough to actually recover the cost. And on the last day, we would get proceeds from sale of this investment, so 30,000. And as 30,000 is on the last day, then payback is actually 5 years. So that is the 5 years of payback. If this 42,000 received in period T4 was received throughout the year, then we would have to apportion that. Now that is our payback. Okay, how about we calculate the return on capital employed? What would be the difference? Well, return on capital employed for the whole project would be this overall annual profit. So annual profit would be, we would take 12,000, but that is not it because that is in fact cash. And we need to subtract our depreciation. So 50,000 divided by 10. And this would mean that annual profit is 7,000. So this means that we would have the annual profit of 7,000 repeated for 4 years. So 4 years worth of annual profit would be 7,000 multiplied by 4. So that is 28. Okay, now we are going to take the value of equipment. That was the average one. So average return on capital employed investment. So average investment would be, we are going to take this investment at the start. So that would be 50,000. We're going to take the investment value at the end. So this is going to be 30,000. And we would divide that by 2. So in our case, that would be 40,000. We need to take average, and when we take average, we add, not subtract. Now, what do we do next? Return on capital employed can be calculated as average annual profit divided by either initial investment or average investment. And we do know that if there is an elephant in the room, it has to be talked about. So if we have an investment at the start and at the end of the year, it is expected that we calculate average investment, unless anything other than that is taught to us. What would be the average annual profit? Well, it actually equals our annual profit. That is 7,000. And average investment is 40. So let me recalculate that. 7,000 divided by 14. 7 by 40, it's 17.5. Now, a few things I would like to note. Well, first of all, I calculated 4 years worth of annual profit. In this case, we do not really need that because we have this annual profit that is the same. So we do not have this scenario that would tell that at first we earn just a little bit and then we earn more and then we earn less and so on. So that is why we haven't changed anything. We can just take 7. Another important idea not to miss is that in this case, we do not take any profit from the sale of the asset. We take it into account in our average investment calculation, not in annual profit. So please do not add 30 to this 28. No. We take that into account. The scrap value is taken as part of the investment calculation. That was return on capital employed. What else do we need to calculate? We need to calculate net present value. Net present value is calculated based on our cash flow. So we do not need to take profit or depreciation, we take cash flow. So we are going to calculate it as we take the initial investment that is not discounted in any way because it happens right now. Then we are going to take the annual cash flow of 12,000, not 7 because it is not profit, it is cash flow. So no depreciation comes in here. And we multiply it by annuity factor of 4 years and 10%. We're given a cost of capital of 10. And we know that annuity factor for 4 years and 10% that is given to us in our annuity table is 3170. And then we're going to add the scrap value. So the cash flows that we have received from the sale of the purchased asset. So 30,000 in our case, we have calculated 30 as the carrying amount at the moment of sale because we were told that there was no profit. So that would be 30,000. And that is 30,000 and it has to be discounted, and discount factor would be also for 4 years and 10%. We take our discount factor table, and we know that that would be 0.683. 0.683. Now I'm going to use the calculator to do that, and we will see that it is minus 50 plus 12 multiplied by 3170 plus 30 multiplied by 0.683. So that would be 8,705. Now, how do we calculate internal rate of return? That was also required. To calculate internal rate of return, we need to take two annual rates and we need to calculate NPV for them. We already have NPV for 10% calculated. Now, the question is, what will be the next NPV? So will we, for example, choose a rate of 5% or 15? And the answer is we are going to use 15 because it will allow us to make NPV closer to the zero. And that would reduce the error. So that is why we are going to take that. So NPV of 15% is calculated the same way. We take minus 50,000 plus 12,000 multiplied by annuity factor over 4 years, but now we take 15%. And for me, 4 years, 15% is 2,855. So it's 2.855. Now, as for discount factor, again, we're going to take 4 years and we're going to take 15%. So it's 0.572. 0.572. Now I'm going to recalculate the total, and the total would be minus 50 plus, one second, minus 50 plus 12 multiplied by 2,855 plus 30 multiplied by 0.572. That would be, oh, that is a lot, minus 38,875. Let me recalculate that once again. 2,855 plus 30 multiplied by 0.572. Is it? Yes, it is. Minus 50,000. Now, see, that was okay. Now I got two answers and they're different ones. So let me recalculate it the third time. So once again, I have minus 50, I have plus 12 multiplied by 2,855, right? Plus 30 multiplied by 0.572. And I got the third version. Okay, hold on a second. I will use my spreadsheet and I will get back to you in a second. Okay, so finally, I'm Okay, with the answer, it's going to be 1,420. And to calculate internal rate of return, we are going to take a lower rate, that is 10%. Then we are going to take the NPV that is calculated at a lower rate. So it's 8,705. Then we are going to divide by the difference of NPV calculated at lower rate minus NPV calculated at higher rate. And that would be multiplied by the difference in the rates. So up, that is it. And now I'm going to use my calculator to do that. And let me see. So the answer should be above 15 because even for 15, we have positive NPV. So I will calculate first 8705 plus minus 1,420. That would be 7285 because I have normal calculator, not a scientific one. 8705 minus 1,420. Good. Now I'm going to take 8,705 divided by 72585 multiplied by the difference of interest rates plus the 10% interest rate. Okay, so that is 16%. That is 16%, roughly. Good, so that is internal rate of return. And what do we have with this investment? So we see that the investment is short term and it needs an equipment that is going to use for just a fraction of it is useful time. So it's just for 4 years out of 10. And as such, your internal rate of return tell you that the return is good. NPV is positive. Return on capital employed is good, but the payback period is huge. And that may be the problem if the industry is very volatile. So, for example, if technology can change fast, or if the economic environment changes fast. So, when we are engaging in investment appraisal, we need to think about what is the key factor for us. Payback period would work very well when there is lots of unknowns. So we want to get our return as fast as possible. NPV is the next best. NPV is usually the best method because it takes into account your cost of capital, because it is easy to make a conclusion. So if it is above zero, then everything is great. It allows to pay in for interest. It allows to give the shareholders a required return and then some. And internal rate of return is great to compare projects of different sizes, but because it is not an absolute but rather a relative measure, meaning that it is stated in percentages, we do not really see the impact on the organization. So it may as well be that the return is great that is provided, but unfortunately the project is very small. So maybe it's not even worth our effort to pursue that. And now let's go and talk a little bit more about NPV, and namely about annuities and perpetuities. So we have a company that is planning to license away Project X for 3 years. It will receive license fee of 10,000 at the start of the year. So if a fee is received at the start of the year, this means that when we calculate the annuity, we will need to take this start of the year as 1. So it will be just 10K. Nothing is going to change. And then we're going to use a annuity factor for the remainder of the year. So for 2 years in our case. And the cost of capital that is given to us as 15. That is the present value of licensing. Now we also have tax. Tax is our cash outflow, so we need this minus sign, and we know that it's going to be 20% from our income of 10,000, so it will be 2,000. But we know that it is going to be paid 1 year in arrears. So this means that we are going to multiply it by a annuity factor of 3 years and 10%. And then we are going to discount it by dividing by 1 plus 15%. Why is that? Because the first tax payment is in year 2. Why in year 2? Because the P&L effect of license fee from which tax is calculated based on P&L, not the timing of cash flow. The P&L happens in year 1. And if tax is paid 1 year in arrears, this is in fact year 2. So in this question, we are going to have the following. We are going to have 10,000 multiplied by 1 plus annuity factor of 2 years, 15%. For ROCE, that would be 15% and 2 years and plus 1. So it will be 2.626 minus 2 multiplied by annuity factor. I said 15%. Yes, and in here it is 15%, sorry. So 2 multiplied by annuity factor of 3 years and 15%, which is 2.283. And that would need to be discounted by 1 period. So either divided by 1.15%, or it will be multiplied by a discount factor of 1 year and 15%. And in our case, it's 0.870. So let me use my calculator to learn what the number is. That would be 10 multiplied by 262 minus 2 multiplied by 2.83, 2283, divided by 1.15. So I got it as 22,230. So once again, we need to be super careful about when the cash flows are going to happen. And we need to be super careful as to when the tax is going to be paid. So actually, the last tax is going to be paid in period 4. And this is 22,230. Now, we have a similar scenario, but in this case, we also have this 500 that is going to be paid after the third payment for eternity. So what does it mean? Well, we will need to take this 22,230. So in previous question, it was 22,230. And then we will need to hand the effect of eternity. So look, 500 will be paid at the start of year 4. So at the start of year 4 means that when we divide it by 15% to find out what is the perpetuity value, we would assume that the first payment is at the end of year 3, because the start of year 4 is the end of year 3. And this also would mean that we need to discount it now. Why? Well, because our discounting works from the perspective that the first payment starts at the end of the year. So as this starts at the end of year 3 and we need to have it at the end of year 1, the first payment, then we're going to multiply it by the discount factor over 2 years and 15%. And that would be 500 divided by 15% and multiplied. 1 second. What was the discount factor? 2 years, 15%. It is 0.756. I'm going to recalculate that. That would be 2,520. But We will also have to pay tax. So tax is 20%. So this means that tax outflow is minus 100. We're going to divide it by 15% because it is paid in perpetuity. And now it means that the first payment, the first cash outflow, is going to start at the end of year 5, actually. Why? Well, that is because the license fee of 10,000 is going to be expensed, so in P&L in years 1, 2, 3. So this means that the first P&L effect of 500 will happen in year 4. And as tax is paid 1 year in arrears, so this means that it will be paid at the end of year 5. So this means that we will need to multiply it by discount factor of the previous year. So multiplied by discount factor of 15% and year 4. And discount factor of 15% and year 4 would be 1 second, 0.572. 0.572. Now let me recalculate it. And that is minus 381. I would not take the cents. Minus 381. So this means that this total NPV would be 22,230 plus 2,520 minus 381. So that is, 1 second, let me recalculate that. That is 24,369. 24,369. And that is it. Now, it is important for you to practice because with your multiple choice questions or with your constructory or with whatever you have to just type in the answer, still with these test questions, you need to be very quick on the uptake. And also you need to be very precise because the cost of an error is significant because a single test is worth more than 1 mark. And that is why you need to practice and practice, especially in these questions that are confusing. So with this delayed annuities, advanced annuities, with this return on capital employed when we take profits and payback period when we take cashless. And that's it. And I will see you next. Bye.